Technology services group Adapt IT released its interim results today, reporting a 1.3% drop in revenue to just over 669 million rand. Headline earnings per share came in flat, edging up by just 1%, while normalized headline earnings per share grew 5%. The group, however, experienced no organic growth from its continuing operations due to challenges in the domestic market, but has plans to diversify. Sbu Shabalala, CEO of Adapt IT, joins us in studio now for a perspective on the numbers released. Thanks so much, Sbu, for your time today. So we've had the weak South African economy really take its toll on your earnings, and with 78% of your turnover actually generated in South Africa, this is hardly surprising. How are you rating your resilience right now?
Well, we're quite pleased with the resilience of our business. It shows that the annuity revenue nature of the software business has kept us where we are. In fact, if you adjust for the business that we sold, so the disposal that we made, we're up 4% of on last year. So that is an important feat. But when we saw that the market was slowing, I mean, it's been 6 months. Our focus was predominantly on driving profit growth. And that's why our EBITDA has grown up.
Where the little growth you did see was more acquisitive based, though, Sbu. Yeah. I've got to ask, do you anticipate that now being the name of the game for a while yet? Because one wonders if these acquisitive opportunities are in fact more rife in the distressed economy we're seeing right now.
Well, we're finding more entrepreneurs that own businesses looking to other homes. So a home like Adapt IT, with our balance sheet, is a much more safer environment. So we have a lot of those opportunities. However, with the depressed market, even our share is underperformed. So our focus is to drive cash acquisition. So there's a limit to how much cash you can apply to these capital, to the software businesses. But we are driving organic growth, albeit outside of South Africa. Yeah. So there's a lot of focus now in the Africa market, together with the Australasian market, as you know, that we've just done a latest acquisition to get us entry into the education market in the Australian market.
So what kind of target do you have in mind when it comes to that international exposure in particular, where right now you're sitting with a 78 versus 22% split?
Well, we're targeting around 30% initially. So we're 8% shy of our target at this point in time. But we know that the South African market will not remain stagnant for a long time. We know we're out of recession now, and we expect that to start growing. But the intensity of our sales outside of South Africa will not stop.
It certainly makes, an interesting climate, the current one we're in, because it's in a context where one of your local competitors is taking serious flack, over allegations of impropriety. To what extent are you being opportunistic and leveraging of what's been playing out locally in terms of managing to gain market share?
Well, the focus for such businesses, as you know, has been in the public sector. So our business is not predominantly in the public sector, but we are looking to the public sector as we grow the business, because we now have the skills, and as these things are unearthed, we believe that that cleans up the public service, particularly the risks around procurement.
I was going to ask, is public sector just too risky a business right now?
Well, with the things that are being unearthed, we believe that those mistakes will not be made again. So if those mistakes are not made again, then it's an opportunity for any company to participate. And we believe that if we put the right controls and we don't make the mistakes that our counterparts have made, we believe that there is a market, because it's also part of what contribution we have to make to South Africa.
Absolutely. Okay, let's leave it there. Sbu, best of luck moving forward. Let's leave it there. Thanks so much for having joined us in studio this evening. Of course, Sbu Shabalala is CEO of Adapt IT.